All right, welcome to stockmarketpunting.com. Here's the S&P 500. We told everyone in our charts on we have a complete segment of the indexes that Stock Market Punting has done. And if you go back last week and the week before, you could see what we were saying then, and you could see the result from what we were saying. We just don't talk to be talking here, because we don't. And if you're willing to take the time and effort, then go back and take a look and see where it is. We said that the S&P would go lower. We also said that the S&P index was overbought. And that's the peak of this weekly overbought. This is the turn. And we're finally coming over off of the exuberance with the reversal. And as long as I remain below there, we ain't got no support until we get down here. Now, everybody knows on Saturday's training session that we had a trade that we would do on the S&P. And we would buy the S&P 1160 call if it got down there for a trade. And we have all the contracts that we traded right here on the S&P. Here they are. Here they are. We had the 1210 puts. We bought some, these are all for the month of May. And we are short. We went long a couple of times in the volatility, and we sold the call. Every time that we bought the call and it went up, we sold it. We let the puts, we bought the puts back again wholesale, and then got entries again. And so our S&P index options, right along with our NASDAQ 100 positions, long and short, with risk management using mathematical imbalance ratio formulas, and understanding that the market had to pull back, but buying that call for the volatility and selling the call and letting the other side of the market run. And I can show you what I'm talking about, letting the other side of the market run, is that during the volatility, when the puts paid big, we came out, we bought the call against it. The call popped, we sold it. Then when we sold the calls, we bought the puts again, and we just kept doing it like a merry-go-round trade between long calls and short the puts. And now the S&P, as long as the S&P, this is last week's big reversal bar, 2 big selling days. So you have 2 selling days and 2 counter trends up. That's how mathematical trading really works, and real mathematical technical analysis based on imbalance ratios. That's what we do at the school. You don't find that anywhere else on the internet, because I know you don't. And the thing about it is, come and take our free 5-day trial, get engaged, get involved, go back, take a look at what we said here, why it would go lower. And basically, as I told everyone then, we were 92%. Now we're 90. Then we hit from 92. We popped up yesterday to last week. We popped up to 93. But guess what? We're 86. So this overbought area, this top, had volatility to the 4 stages of the S&P SMF market top trade management formulas. And basically, this is where you know how to let this side of the market run, but now we're in a reversal. And every reversal has a volatility stage in both directions, up and down, mathematically up, mathematically down. And then eventually the one side of the trend will go lower within the volatility, and that's what you're seeing here. You've been given a gift on the S&P. We trade the S&P 500 indexes every day of the year. Our school addresses market tops, market bottoms, wholesale entries, selling to retail, SMF, Pro Trader, Market Maker School.